Hello and welcome to Moneylife News and Views. I'm Debashis Basu. In early November, I wrote a piece in Business Standard and also republished in Moneylife, suggesting that the Indian economy is functioning as expected, which is muddling along. It rarely falls into a full-blown recession, but it also struggles to achieve sustained growth, sustained accelerated growth, which a lot of people have been expecting for a long time to make India into a developed country. Now, this observation was immediately illustrated a couple of weeks ago, or maybe 10 days ago, when India's GDP growth, after reaching 8.2% in financial year 23-24, fell to 6.6% in Q1 and then further to 5.4% in Q2. So 8.2, 6.6, 5.4. Growth is unlikely to return to 8% anytime soon, but it also seems unlikely to dip much below 5%. There used to be a term called Hindu rate of growth. That's nothing derogatory. It's an old term about 30, 40 years ago. We have to make these kind of caveats that there's nothing derogatory, because in today's environment, you can't even mention any of this. But economists had a term called Hindu rate of growth, which was just 3.5%. That was described for the slow growth that India achieved between 1950 and 1980, just 3.5% per annum. Now, the new Hindu rate of growth is probably 5% or 5.5%. That's been an improvement. The official reasons for the economic slowdown, which we're seeing right now, is in the last quarter are all different. One, the Reserve Bank of India has had a restrictive monetary policy. The government always wants them to reduce. Government and consumers and businessmen want the rates to be reduced, but the RBI cannot do it. It looks at inflation and other factors, and it had kept the interest rates unchanged, which the government calls restrictive. Second point, low government capex, that is capital expenditure due to ongoing general and state elections. And three, the government says a slowdown in private sector capital expenditure due to domestic political factors, global uncertainties, excess capacity, and fears of dumping in India. These are all three major official reasons why the economy slowed down in the second quarter. Now, these explanations are accurate. They're correct. They are the right explanations now, but they are merely today's causes at the moment. The underlying reasons can shift. Next time the GDP numbers are announced, the slowdown could be attributed to global economic weakness, rising oil prices, another drop in domestic capex, and any other factor. If there is a weakness, that is. We could go back to 6% or so. So again, there would be some other factors which would be then the positive factors. It all makes very little sense. The fact remains that the economy is weak, hampered by poor policies, poor governance, including high levels of corruption and a high cost, low output structure that we have. Our costs are very high and our productivity is low. The government's monthly economic review for November 2024 points out the following. Private capex levels are affected by global uncertainties, excess capacity, and fears of dumping. Now, these are structural issues that cannot be solved quickly. How then will private capex suddenly rebound in the coming quarters? What will get India rid of its excess capacity and fears of dumping and global uncertainties? The Indian economy has largely been on autopilot, delivering only modest growth, which may be higher than many other countries. It is not sufficient to propel India rapidly into middle income status. The prospect of India entering the rich country club, well, that's really laughable. The critical question is whether the stock market reflects this reality. A 6% growth rate is good, but not a sufficient reason for a runaway bull market, especially when Indian stocks, particularly in the small cap sector, have had an extraordinary run in the past 2 years. The S&P BSE Small Cap Index shot up 47.52% in 2023, that's calendar year, and again 29% in 2024, the year concluded. The Nifty Microcap Index did even better, 66.44% in 23 and 34% in 24. Meanwhile, the Nifty 50, weighed down by the slow growth of large cap stocks, which is Hindustan Levers and HDFCs of the world, rose by 20% in 23 and only 9.6% in 2024. Yet, for the ninth consecutive calendar year, the index closed in the green. And yet, it would be naive to assume that these exceptional returns will continue indefinitely. The question that investors should ask is, if economic growth remains modest at around 6%, can the small and the micro-cap sectors continue to deliver extraordinary revenue and profit growth? There is actually a case to be made for smaller Indian companies continuing to do exceptionally well, better than what they did in the past, and the growth may continue. Since the last quarter of financial year 23, that is 22-23, they have benefited immensely from massive government spending. After years of slow economic growth, the Modi government tried to boost it by spending around 10 to 11 lakh crores every year for the last 3 years on infrastructure projects such as railways, roads, urban transport, waterworks, energy transformation, and defense production. Government capex as a percentage of total expenditure reached 28% in financial year 24, up from just 14% in FY14. The massive amount of government spending. However, while government capex increased by 33.7% last year, it has contracted by 6.6% in April-October FY25. As the main engine of India's economic growth has slowed, GDP growth has also weakened. There are expectations that government capex will rebound sharply in the last quarter of this year, which is typically stronger than other quarters. A lot of money has to be spent in the last quarter, otherwise it just lapses. However, the challenge with relying on government capex is that it is heavily dependent on government revenues, and those are weakening. With the economy now settling into the new Hindu rate of growth, the growth in central government gross tax revenues has fallen to 10.8% in April-October FY25 compared to 18% in financial year 23 and 14% in FY24. So 18%, 14%, 10.8%. This is gross tax revenue growth. Similarly, goods and services tax collections have slowed down significantly. FY23 was 26% growth as the economy rebounded from COVID, but it was only 11.9% in FY24 and 9.3% in April-November 25. There are other worrying signs emerging as well. In April-November FY25, growth in power consumption was just 3.9%, down from 9.7% in the same period of FY25. 3.9 down from 9.7. Cement production 1.8 from 3.3. While it's too early to draw any definitive conclusions, if these weak indicators persist, there is a risk that India could slip into a little longer slowdown, similar to the one we experienced in between 2014 and 2019, the first term of Mr. Modi, when growth was not so much on the agenda, as was all kinds of social norms and changes, and etc. The best case scenario is that these indicators improved only slightly. After all, there is no reason for them to improve significantly. After all, where are the engines of growth? There's only one, which is government expenditure. Indian exports are weak. Indian private sector is doing its best, what it is, and there is just no other engine of significant growth. So regardless of whether we face the worst case or the best case scenario, what happens to the high growth expectations already priced into the stock market, especially in the smaller companies after 2 consecutive years of exceptional returns? And that is a key question for investors. We will have to monitor this very closely, whether something more is happening in the economy where smaller companies are delinked from overall economic growth. Whatever growth is happening is probably good enough for them. I don't know. We'll have to wait and watch. If you liked what you heard, please do share this video and do subscribe. Thanks for watching.